Morning to all of you guys, and thank you for coming out today on a Wednesday morning. It's great to see a full room, and a big thank you to the organizers of this event. So thank you, Aditya, thank you, Moniz, BD, and the rest of the team. I think it's only appropriate that we start with a more futuristic panel first up. And we've got three great speakers, and I've promised to ask them some very difficult questions. So I'll start with you,
Sure.
Sanjay, because you've been at the forefront of angel investing and creating new companies and new ideas, right? So as you see this, and you've been an entrepreneur yourself, you're a very active investor, and also a manager of funds. What are some of the emerging areas that you see in the alternative investment space, either through your portfolio companies or as a client of other offerings?
What I've been exposed to last couple of years and which has been very exciting is purely on the B2B tech side, while consumer was the flavor in the early starting of 2000 kind of stuff. Now it's purely AI, ML, IoT, blockchain. Now that's the key spaces where we are seeing a lot of action. Personally, I'm a firm believer of blockchain technology, decentralized world, decentralized economy. I believe that next decade we are going to see a huge disruption in whatever we have seen in past. What internet brought in, it's again set to disrupt with blockchain. Be it Facebook, be it Uber, be it LinkedIn, everything is set to disrupt due to the blockchain technology. As India, we missed the first bus in terms of the internet side of it, creating those unicorns or creating those first opportunities like Amazon or Google. This is, with blockchain, is the time for India and typically Indian entrepreneurs who would like to look at creating that next unicorn from India. And I believe that decentralized economy is going to change the way we look at businesses. While most of us look at Bitcoin as one of the cryptos or highly volatile currency, or mostly in the news people talk about the pricing. But think across Bitcoin as the first global bank with no employees, no corporation, nobody to pay, and has a still value store. Now that's the disruption what it is causing. And it's just unstoppable. While no government can shut it down. Today, for example, you have your money in your bank account. Tomorrow it can be flagged and you lose your money. We have seen across countries failing from Zimbabwe, or we had our own demonetization. All these things are typically does not exist in the crypto world. Today, Bitcoin, nobody can take away. It's a world which is free, which is permissionless. For everything in our current economy, government controls, everything requires a permission. When you swipe a card, you require a permission. When you issue a check, you require a permission. In the whole blockchain world, everything is permissionless. It's a free, completely free world. So we are going to see immense amount of disruption, and I believe future is blockchain.
Great. And do you think, Sanjay, that it will have an impact on other industries also, other than banking and
No,
financial
it's going to disrupt every possible industry. So think across, like, for example, ride sharing, Uber, right? So who creates value? The taxi riders. And who extracts the value? The taxi drivers. And who makes money? Uber, right? So, and Uber shareholders, and the whole economic mismatch is there because nobody has a vested interest on creating that network. Everybody is working for their own selfish interest. Now think across with blockchain, what will happen is we remove the intermediary, which is Uber, which is a smart contract, just a smart contract fulfilling company, and when rider is paying directly to the driver. It's a peer-to-peer economy where I don't need intermediary like Uber. And the whole economic loop is completed by those crypto or the token which will be issued for that ride-sharing app. Now, that's like you have got more commissions for the taxi rider drivers. Taxi riders gets lower cost. It works. I mean, how can you compete against those kind of, vested interest against which where Uber kind of apps are existing? So that is what blockchain is bringing. It removes all these intermediaries and works between peer to peer.
Great. Girish, I'll come to you. So we have now had about 5 or 6 years of the AIF regulations being in force. From your vantage point, what are some of the key regulatory or tax changes that you think are required to really turbocharge growth for this industry?
So I would say the change has been massive, as you said, but the tax change has lacked the change. So as you talk about bitcoins, how will bitcoins be taxed? Where will you tax bitcoins? I mean, you may just receive a computer currency. When will you pay tax? You may not even tell anybody you have a computer currency. So clearly the tax changes have been lagging the changes which are universal. So last 3-4 years, there is this big thing that tax reform should happen. There should be more certainty. As far as AIF is concerned, there has been an attempt to make it pass through category 1, category 2. Category 3 is now being debated. But there are some pressure points, and you spoke about 69 angel investments, and the pressure points are when you invest at a value. And there is a provision in laws saying that if you invest in a startup, and if it's more than the real value of the startup, then clearly that's income in the hands of the startup. And that's a bizarre provision, because what is real value? How do you demonstrate real value? How do you convince the tax office that that's real value? And that's been a big bone of contention. I don't know how it's in your 69 companies, but that's a big bone of contention.
No, we are struggling every day. We have got notices. Income tax guys are hounding startups, saying that, because you have received money from investor, that is considered now as an income. So you pay tax on it, which I don't know how, who is smoking what at the government level.
So, rightly said. So that's the first issue which is facing startups and the private equity or the angel investments going into the startups, because if value loss happens, it happens to you also. Second is on change of shareholding, carry forward of losses, are the provisions adequately enabling for that to happen? And there are bigger issues like how do you deal with, newer stuff happening, taxation of e-commerce, Google tax. How do you deal with all this? So the law has evolved, law has emerged, tax treaties have got tapered down. AIF is still looking to be a good investment platform, but it's continuous. The reality on the ground is it is litigious in many, many ways, as I see this.
Any specific changes that you...
In the budget, clearly, directionally, when we go to the government, I mean, if you look at the public market money versus the AIF money, public market money is around 30-40 times the private equity money in this country. So government's focus is the stock market. So you'll hear a lot about long-term capital gains tax coming, not coming, and a period of holding going up or down. The focus on AIF is not too much. The focus is on REIT and InvIT. In this budget, the focus is more on the public markets and then REIT, InvIT, and IBC also the big focus area, because IBC, whether the debt write back is taxable, not taxable, MAT on debt write backs, and so on and so forth. So AIF is muted for this budget, I would say. So the pass-through exemptions are there. Category 3 should be included, not included, is a big debate. We are hoping that this clarification on 56 to 7B on this fair value issue of shares comes through. And to add to it, there's a lot of applause. Oh, GST is coming in. Companies Act has changed, income tax has become more enabling. But there's a contradiction in all this. I'll explain to you. There's a valuation as per the Income Tax Act, there's a valuation as per the Companies Act, there's a valuation as per the FEMA Act, and all are contrary because all have their own formulas. One says, FEMA says invest at minimum price, tax says invest at maximum price, Companies Act says invest at this price. So it's so contradictory. So how
And
will
we
this,
all end up paying you money.
you end up paying money, but the thing is, when the client is not happy, consultants are never happy. So the fact is that getting all this harmonious is not a budget exercise. It's an evolving exercise. But in the budget, hopefully on this issue of shares, transfer of shares, there should be clarity. And there's a big ask of lowering of tax rates. I don't know how startups will survive when US is going down to 20%, UK has gone down to 20%. And is there a case to have a lower tax rate to promote entrepreneurship and these angel investments happening in this country? It's something to be watched and debated.
Thank you, Girish. Sudhir, I'm going to come to you. So you're a veteran of markets and market cycles, and really a very flexible provider of capital to entrepreneurs and businesses. What are promoters and business houses asking for today? And what are sort of the next generation of solutions that private equity firms are bringing to the table?
So like everything in the country, this last 15, 20 years has seen a lot of evolution of our industry as well, in terms of what we started off as. Probably many of us, I came from a credit background into private equity. Some of us came from investment banking background. Little knowing what exactly private equity entails, in the sense that what does it mean to be a partner in a business? And for both us as providers of private equity, for a entrepreneur who is taking money from private equity, it has been a learning experience of what this beast is all about. I think that has now matured. Now, for example, when a entrepreneur seeks private equity, there is a knowledge. Private equities know what it means to conduct themselves. So now I would say it's a fairly mature asset class from understanding perspective, from what are the bells and whistles that are required for private equity to function. For example, going into investing into probably 5 or 6 sectors, the P does not have the expertise to really run a pharma company or a hospital or a financial services firm. But you need to have access to talent which is willing to come and work with P, and that today there is an ability to attract talent that is there. How to work with providers of services to us, like tax firms, I think. So that to that extent it has matured, and you are able to therefore become a very meaningful provider. So today that asset class has clearly matured. I think now you will see the next phase of what private equity is really capable of, and which is needed, in the sense that today, for example, there is a substantial part of companies in the Western world which is private equity owned. And that is bound to come into India, as intergenerational transfer of wealth is not by passing on company from one generation to the other, but passing on wealth from one generation to the other, because the next generation may want to do a very different scheme of things. And you need to know whether it is saleable, in the sense that is there a buyer at the other end who can indeed buy and run the company. I think today you have a set of firms which are confident of saying that I can take over ownership of a company, and I have the tools that are required to own a company and run it professionally. So I think that's where we are. I think the next 10, 15 years for our industry would be, are we able to live up to this promise of the industry of being responsible, capable owners of businesses in a professional setup? Can a multiples act like a corporate group in terms of owning companies? I think that's what the next 10, 15 years holds for us.
Great. And Sudhir, so a lot of our alternative investment industry today in India is very domestic focused, both in terms of its in where we are investing money, as well as the AIF industry obviously is completely based out of domestic LPs. But you guys at multiples do have some global LPs as well, right? So how do you see the dynamic between domestic and global LPs playing out? And do you think it'll come to a point where you'll start to see money raised from India start to invest overseas in a formal fund structure?
So currently, in fact, bulk of our money is overseas, right? So when we talk about raising a $700 million fund or $1 billion fund, you're saying that more than 90% of the money comes from international pension funds. And these are the guys who write checks of $100 million and $200 million into funds like us. And the capability of the domestic market, and as our fund size increases, the proportion of international money is only increasing. While it is desirable that we would want a large amount of domestic participation in it, because domestic ownership in the fund also gives us access to a domestic network which is required for providing the support to the companies. But that said, today I would say that internationally, of course, these are all institutions which are funding us. So these are large pension funds and sovereign funds which are investing with us. The pension fund structure in India is not conducive to investing in private equity. For example, it's kind of highly disparate, the provident funds that exist and the way it is managed, etc. It's not conducive. It's kind of regulated. Even public market investing for them is so restricted, let alone private equity investing. So the access of capital from institutions is low. Family offices, my sense is they're still kind of testing us as private equity as to what it means, because there is a plethora of private equity funds who are really institutional and long term and who are able to, is I think being assessed, because currently the focus is still in terms of ability to liquidate fast, to ensure that you have access to liquidity, while our international pension funds are kind of very happy to say, if I go and say that I'm investing into a housing finance company. I mean, we have incubated a housing finance company, which is now about 1,000 crore portfolio, and I have a 10-year outlook on this. They are quite happy to say that I'm not so sure what is the kind of risk appetite that would be there in the domestic market for something which is as long-term, or will be, I'm sure there will be some amount of access, but would it be wide enough to kind of meet the requirement of some of these highly capital-intensive sectors that we are looking at? So I guess it's an evolutionary process. Eventually, we will be able to start attracting. Also, in a market which is as hot as now in terms of the public market, it also becomes difficult for private equity fund with a long hold kind of to go and make a pitch. So that makes it difficult as well to access the kind of capital from domestic sources. So if I look at it, where is my next fund going to come from? I'm still going to go around with the bowl to the international centers.
I mean, being an LP into fund also, the way I started looking at it is, most of the guys are saying, we'll give you 15-20% kind of return and stuff. Well, utna to dhande bhi milta hai. Why should I give money in this risk? So from an Indian context, it becomes little challenging, while foreign investor might find that attractive.
Sanjay, are you investing overseas also? Like, are you putting money into startups in Silicon Valley? Or?
Yes, I've been investing. So for us, I mean, it doesn't matter whether it's an Indian, you just need to be the right company where we see a great alpha and opportunity we would invest in. In fact, one of my current success is one of the blockchain company, which is an overseas company, and it is already valued at around $6 billion. So it doesn't matter, I mean, for us to invest whether it's India. But yes, we have an LRS limit of 250,000 per person as such. But within, I mean, family, you can do up to $1 million kind of easily.
Girish, you mentioned REITs and InvITs, and we were actually just chatting before this session that that's a space that everybody wants to take off, but it hasn't hit an inflection point so far. What do you think are the key things to get InvITs right? And what are some of the lessons for REITs whenever they are launched?
So I think before I get to REITs and InvITs, I just want to go back to your point on international investing. International investing, we all want to hold shares of Google, Amazon, IBM individually. Why not? And it's not very enabling. So like we can invest up to $250,000 a year per person. And banks are not interested. So if you put your hand up and say, I want to invest $250,000, they will tell you it's too small and the brokerage and everything is far too expensive. They don't do a KYC on you. So that's a big market in terms of overseas investment. Can you make a pooling vehicle in a country which is overseas, get investors down and invest in these stocks which you want to? That's a big opportunity, which I have 8-9 people who are working on this kind of opportunity, where it goes. In terms of AIF investing, this 25% limit, do you need a 25% limit? Why can't you invest as much as you want and move towards rupee convertibility, especially if you're talking about a Bitcoin world and a global world, where it's, so there's a lot of regulatory need to enable overseas investment, which also a lot of Indian investors want to de-risk countries and so on and so forth. REIT InvIT. REIT is not taking off in India yet. And why is REIT not taking off in India? It's not a regulatory or tax issue. The issue is more to do with returns, because real estate returns, as you said, 15-20%, I don't think you have double-digit returns. And at best, whatever I hear is that real estate is now over. I mean, in the sense the appreciation is not that much. Affordable housing is there, commercial is there. But I don't see, people come to me for REITs, I haven't seen a business plan of a sustainable double-digit return. Forget above 15-20%. So that's a big downside. Whereas if you look at, say, Singapore and all, people have 8-9% in dollar term, and that makes REIT happen. Because 8-9% in dollar term is big returns for Singapore markets. In Indian markets, you have far many alternatives which are far more than that. InvIT is now taking off. You have 7-8 InvITs done. But there the asset period, like people like to invest in tolls which are like, 16 years, 18 years average. Here the earning assets don't have too much life. So like pension funds want longevity. They want to invest and forget. Like if I put in an InvIT for say 15 years, I don't need to worry. I mean, there is no end period for the asset which is there. So there are very few income generating assets which have an average maturity of more than 10 to 12 years. And for an InvIT to be successful, that average maturity is around 18 to 20 years. That's what the Singapore experience is. So the way I see it is, REIT will not pick up till real estate looks good, and I don't think real estate looks good for many months to come. And InvIT will depend upon how many more income generating assets which are there, which are more than average of 18 to 20 years. Tax is now enabling because the exemptions are clear, the pass-throughs are there, and putting it together is there. And SEBI is also very efficient because they're clearing the applications and approvals. But the commerciality of these two, and then when you compare it with AIF, and then you compare it with PMSs and public markets, people, why will they invest below 10%? And now Bitcoin also. I mean,
that's a big challenge, right? What is to attract capital? What is the right risk return, in the sense that today, if you're pitching, and Sanjay alluded to it rightly, in the sense that if you're pitching, the domestic market's risk appetite is much higher because they have seen returns coming from public market far too easily. So nobody values, if somebody were to say that here you can get 10% or 8% on holding this road for 20 years, there's no value for that because you think that I can make 20% for 20 years. Why should I hold 8%? Now, the appetite for an international investor, probably who has seen more cycles, whose kind of risk appetite is kind of tempered by their experiences. A CPPIB and some of those real estate deals that have happened in the country where large pension funds has put in several $100 million are being underwritten at 6 and 8% kind of a return. So they believe that if I can get it over 20, 30 years, that is good return. We believe that this is kind of 20%
they have almost,
Yeah,
so it's globally virtually zero, Sudhir. So
yeah.
But that also, what he says is not happening in REIT InvITs. They are happening in assets. Like the Brookfield-like deals are real estate deals wherein you do debt push downs, IRRs are different. Whereas in pure REIT InvIT, that also is not there because of the...
And the entire portfolio construct, I think we will have to, I think Indian families and people will kind of come at some point of time as to what is the right portfolio construct to have. Is it kind of, in today's market, for example, there's a thought that you should invest, there is a certain percentage of equities that you should invest in, and I think that percentage is only going up. I think each generation learns by itself, right, in terms of what kind of every bubble kind of makes a set of people risk averse, and then there's a new set, and we are a young economy with growing number of youngsters whose kind of risk appetites are high.
Sanjay, you're a very active investor, even outside of startups. Do you see any gaps in your portfolio that you feel that the alternative industry can meet?
I wouldn't say gaps in, but we don't have a mechanism where, so for example, when most of the startups would pitch us, they would put in saying that we'll give you exit via IPO. IPO for startup doesn't exist in India because the kind of SEBI norms are there, the 3 years profitability and stuff. So the whole cycle where money rotates, it doesn't happen as quickly. So more or less we are dependent on VCs or PE or corporates for an exit kind of stuff. But what I see across and which I think is changing right now is the VC market or the private equity market itself is set to disrupt. So most of the people who are thinking to raise money are going to look at ICO as the first route. Try to see across how they would be able to raise money via an ICO, and which I think is disrupting the whole VC industry by itself. So I think it's just changing the whole landscape.
Before we open up the floor to questions, I'm just going to ask you guys each one question in a rapid fire format. So just hit me with whatever comes straight off the top of your head. I'll start with you, Sanjay. The price of Bitcoin 1 year from now?
$20,000.
$20,000. Girish, long-term capital gains in the budget?
Exemption will continue.
Exemption will continue.
Period of holding for short term will go up.
Good. And Sudhir, the Sensex 1 year from now?
You asked me the toughest, yeah.
You have to answer. And we'll invite you back next year on the panel and we'll compare your answers with what actually has happened.
I think it's still looking like another 15-20% up because the flows don't seem to stop.
So that's about 41,000.
What's it now?
He doesn't want to commit.
Great. Thank you guys, and I'll take a few questions now from the audience for our panelists. Yes, gentleman at the back.
This is to Girish. Hi, Abhishek here. Girish, for InvITs specifically, though they've been launched in an equity sort of a scenario, but if you look at with underlying assets being the infrastructure projects, it's more of on the debt side. If you compare it off and giving a return of double digit, maybe 11-12%, still a person who is investing into debt, comparing that to InvIT is giving a little bit more return than the debt instrument. So still, like, why are they not taking off? It's just because they are not positioned as debt instruments, they're going into equity sort of a thing.
I think the issue is, let's say if you have a liquid debt instrument giving you 10% versus the InvIT giving you 12%, which is SPVs below the InvIT and upstreaming of cash with a lot of regulatory stuff. I mean, you're in this country, sometimes toll gets started. The risk associated still is there. I've seen business plans wherein you have income generating assets and for 2 years something happens and some disruption happens in it. So what is important is we've not been able to get many bouquets of assets, which are like, if you have 25, 30 assets, which are long in terms of duration, so the risk of 1 or 2 can be offset against the magnitude of this whole thing. So any company which I deal with, they would have 12 assets, 6 under construction, 6 under getting into income streams, 6 into income streams. And then if 1 or 2 gets sour, it becomes a big issue. So till you see a sustainable block of assets, which very few exist in this country, this looks to be a big challenge according to me. And the other part is that the companies which are doing this are the companies which are also in trouble because they've been over debt laden. They're trying to solve their debt problem through this. So the sustainability of all that also becomes to be a challenge because these companies are also getting chased by regulators. Oh, this approval is not proper, that approval is not proper. That brings in uncertainty on the whole continuity of this whole thing. I think it's going to only go down actually in bit. It won't take off more.
Hi, my question is to Sanjay. Sanjay, as I hear from you, all the venture capitaling and the private equity is going towards the technology side and the path-breaking, disrupting technology side. I would like to understand from you, how is that the private equity is moving towards the SME side, let it be food and beverages industry or the SME manufacturing kind of a companies. Are we really concentrating on that side because that also contributes a lot to the GDP numbers? How is that in the future we would see a lot of allocation happening to this side?
So first and foremost, from the startup side of it, we don't invest into anything which is asset, kind of creating where I have to real estate kind of projects or where you need a lot of land and machinery kind of stuff. Because that takes away a lot of the capital. While we invest small amount of capital where we want to see across an exponential growth across. So banks would be the best way to raise money for this kind of projects. While on the larger scale, I think private equity companies are investing into manufacturing, real estate and stuff. But from the angel VC side, I don't see any change in terms of saying that will real estate attract across angel investor or VCs? I don't think so, or even manufacturing. So I don't see. But yes, there are places like brands where angels have taken investments, but those are all where they are creating new category or trying to change across the or challenge the current incumbents with different set of offerings. So there has been investments in brands, but not in just plain vanilla manufacturing kind of stuff.
Hi, myself Suyok. I would like to ask question to Mr. Girish, and this is regarding REITs particularly. Since you mentioned that the commercial part is not probably working well, and that's why REITs are not, going to the next level. Is there any steps taken by probably regulators or bodies to do something to this particular segment?
So I would say, I would not say commercial part. I would say the REITs are into 3 parts. One is the real estate, which is the housing sector, affordable, non-affordable. Non-affordable is not REITable at all, because affordable is something which big projects come up, but they are also on resale sort of thing. You have commercial properties, you have business centers. So you have all these, WeWorks and all coming up. These are all owned by somebody else, managed by WeWorks. So on the commercial part, the IRRs are not getting to be sharpened enough, because now people are hoping that the economy will take off, and if the economy takes off, there will be better uptake of people. Now the things going positive for that is there's demonetization which has happened. There is now radar which is in place. So the sector is getting more and more regularized, more credible. So obviously the credibility will lead to better REIT prospects. But there are 2 things which are getting to be in the way of a lot of prosperity of the sector. And I would look at it, say, my business. I don't know tomorrow that will I need more seats? Will I let people work from home? Or will I need half the number of people? Because automation and virtual offices and, work from home and half number of people are turning out to be reality. And that's what is happening in the IT sector also. People are laying off people. 10% is being cut by X company or Y company and so on and so forth. So there is an uncertainty on the expansion capability. So to beat that, entrepreneurship is the only option. Like, are we going to enable job creation? Are we going to enable a lot of entrepreneurship ventures coming up in this country? So if the fear of this automation is offset by the entrepreneurial concessions, entrepreneurial enablements, some zones where it will be tax-free or some zones wherein you will enable people to have a lower tax rate, then the REIT will become a reality. So presently, all the transactions with pension funds which are happening are these long-term players who will be in business, who will be having commercial properties, but that's not the norm, because the positives are there are negatives, and there is hope that in the budget, entrepreneurship will be pushed up to offset the automation and disruption.
We'll take one last question from the back.
This is for Sanjay. Sanjay, you talked about investing globally via the LRS route and with your combining of your family fund to it. So my question is related to how difficult was it to find a structure for those investments? Because if you've been diversifying and doing in different asset class, how did you go about and what challenges did you face across?
No, so I have invested only in startups overseas. I have not invested in buying a house and stuff. But couple of my friends who have already taken house because they wanted to diversify country risk kind of stuff based on their advisors. But for me, it has been just a simple LRS, go to the bank, finish the documentation and transfer or wire the money into the startup. So I've never bought any other asset than unlisted equity.
Can I expand on that?
Yeah, please.
From a regulatory standpoint. So $250,000 is the scheme. $250,000 says you can do whatever you want to do. And $250,000 includes your holidays. It includes your overseas visits, the hotel expenses you incur, the car bills you look into. So you take out that, and the balance is what you can repatriate every year. Now, $250,000 is per individual. So if you have a 1-year-old child, 2-year-old child, and a wife and a parent, so you add all that 250, and that becomes your annual investable limit. So with this, you can do startups, you can do whatever you want to do. House, if you can manage in this $250,000, fine.
No, so typically what happens is, most of them, they do it across the transaction in March, so that the payments are done in March and April and the house is bought. So there are ways where things are happening.
So people do it in trust formats. You buy a house, you take a loan, you put $250,000 every year, repay the loan, and hopefully you get fine. The problem is if you have to invest in, say if he wants to invest $4 million in a startup, that's not $250,000. And how do you do that? And then for that, you need to have a company. For a company, the limit is 400% of net worth. And that company has to have some synergy with what you're buying. So it has to be a strategic investment, so on and so forth. So I have a lot of people who, your friends, some of them maybe, where people have just said, okay, ghar le lete hain, chalo ghar le liya, company leke. But it has to be synergistic to a business. So people said, oh, we'll set up a Singapore office, use it as a guest house and all. Today getting RBI queries, Baba, if you're an individual, what business you're running in Singapore? Please justify. Because you can't invest in real estate under the ODI scheme.
World over, we have got all the startups and entrepreneur disrupting. In India, government is the biggest disruptor.
Correct.
Right?
Correct.
So we have got GST, suddenly some state will ban liquor, suddenly state will ban XYZ. So either industries can start or stop based on government.
So $250,000 is the only credible scheme. Balance is all playing with law.
So when you invest with your family,
So
say
I would request that we
Okay.
take these questions later. Our panelists will be around. But thank you once again, Sanjay, Girish, and Sudhir for a great session. Let's give them a round of applause.
So thank you so much.